I believe you're in the camp of a double dip recession.
Yeah, something like that. Not for South Africa, funny enough, but for your developed world, the US, UK, and Europe. I think basically the measures that they took to try and avoid the worst of 2008 are what I call balance sheet depleting measures. It's damaged the wealth of the countries and their ability to grow going forward, and they haven't really resolved the core issue, and that's debt. And
I'm interested in that point that you say you expect a double dip in the developed world.
Yes.
But we're going to remain immune.
We're not immune. We're correlated, but I think we'll be able to escape with maybe a muddle along, and that's along with the rest of the emerging markets. I think we need to realise that there has been different paths that the developed world and emerging markets have actually moved along, especially since the emerging market crisis. If you remember, at that stage, the developed world were trying to mitigate the problem by cutting rates and expanding government expenditures and the like, whereas the emerging market were forced to cut back government expenditures and hike interest rates. It was exactly the opposite strategy. Very painful at the time for emerging markets, but I think it helped to put emerging markets on a much stronger footing, because effectively those were balance sheet building measures that were taken because your savings were built up, for instance, and by those measures, which is part of the fuel that helps to actually generate economic growth, which is why you've got such stronger savings rates now, I think, in the emerging market world. And you've also got stronger growth. You've got better capital allocation when you've got a decent opportunity cost for your capital, and that's basically, part of the reason. And then, of course, expanding government expenditure, the weight of government on the wealth-producing side of the economy is much stronger in your emerging markets compared to your developed world.
Let's look at the data out on the local front this week. We had PPI coming out at 7.7%. We had CPI coming out at 3.7%. Both these numbers way below expectations. Let's start on the inflation front.
Yeah, I think basically inflation clearly becoming a function of the rand, and the strength of the rand is basically what's holding it there. There's, again, two different paths: administered prices versus consumer goods, and also food prices. The strength of the rand helping to actually subdue the rest of the inflation rate. If we didn't have an administered price problem, our inflation rate may well be below the target band, which is encouraging in the one sense, but obviously dependent on a continued strength of the rand. The moment the rand starts to weaken, we may well end up with an inflation problem.
Do you think that the rand will weaken? We just had Alan Chan, Rand Merchant Bank, saying that dollar rand at year end will be at the 8 level.
I'm more in the 650 camp.
You're in the 650 camp. Whoa, controversial like today, Chris. I like this. Why are you in the 650 camp?
Well, basically, it's again because of the double dip concerns. Effectively, you've got no growth and no yield in your developed world. An enormous amount of the system has been flooded with liquidity. Where do you get yield and where do you get growth other than emerging markets? And I think we'll continue to see the inflows of capital coming into the country, not just South Africa, but the rest of the emerging markets. You've got the euro and the dollar highly compromised as currencies, and I do think that as that continues, you'll see the rand start to move stronger. It's when that party stops that you'll see a weaker currency.
But that party, in your opinion, is going on longer?
Well, the US is going to keep interest rates down at 0 for much longer. The Japanese, the same thing, etc. And so,
so foreign inflows, is the bottom line carry trade is holding up our rand?
I would say growth-seeking funds, not so much a carry trade. I don't like that, because in fact rate cuts also help to strengthen our currency. We've seen that as a pattern over the last 10 years or so, that during periods when rates are rising, that the currency tends to weaken, and when rates are falling, the currency tends to strengthen. And that is an emerging market phenomenon that you see with Brazil, etc., because I think investors go for emerging markets for growth reasons and not necessarily for yield reasons. So it's not to say the carry trade isn't there, it's just that it's not dominant. All right.
You've given us a very controversial stance. Double dip recession in the developed world is on the horizon, in your opinion. 650 is on the cards on the dollar rand.
Further rate cuts.
Yes. Now, are you looking for further rate cuts?
Absolutely, further rate cut. I think with the growth starting to falter externally, and it wasn't quite clear that the growth is in fact, surging ahead here. With inflation well entrenched in the target band, I think the central bank will be tempted to cut.
Chris, thanks very much for your time.